Welcome to the deep dive. Hey, want us to tackle a specific stock for you?
Yeah, tell us what you're interested in.
For just Euro 4.99 a month, Stock Analytics AI members get their requests prioritized. Just drop a ticker in the comments.
We love getting those suggestions.
Today, we're plunging into MRA Holdings Inc. That's NASDAQ, ticker MARA. We're looking at it as of May 19th, 2025.
And our goal here is pretty clear, right? We want to look at MRA through that rigorous value investing lens. Think Warren Buffett principles.
Exactly. And just a note, all the sources we pulled for this are linked down in the description for you.
Good stuff. Now, MRA, he's got quite a story. Started out in patents,
Right, a patent holding company.
then pivoted hard into Bitcoin mining.
Yeah.
And now they're aiming bigger, talking about being a leader in digital asset compute.
What does that even mean in practice?
Well, it sounds like vertical integration is key. They want to control low-cost energy, develop their own tech. They're even looking into things like CASPA and AI infrastructure.
Okay, so it's not just Bitcoin mining anymore. This evolution, patent troll to miner to this broader digital infrastructure play, it definitely signals ambition.
Huge ambition. But let's be real. MARA's fortunes are still, massively tied to Bitcoin's price. Very volatile.
No kidding. So while they're making these big strategic moves to build some kind of advantage,
They're also dealing with a lot of operational challenges.
Yeah.
And market risks, of course.
and just for context, on May 19th, 2025, the stock closed at $16.21.
Now, trying to apply classic value investing here, it's tough. The whole industry is just so volatile, so speculative by nature,
Exactly my thought. I mean, MARA talks a good game about efficiency and cost control.
which they are working on.
But their history, consistent profits without relying on Bitcoin going to the moon, it's not really there. Plus, they've leaned heavily on external financing.
And Bitcoin itself is still speculative, fundamentally.
Yeah. And that makes their reported earnings kind of wild, right?
Oh, absolutely. Huge swings. A lot of that comes down to how they account for the massive pile of Bitcoin they hold. Fair value accounting,
Right. It can totally mask what's actually happening in the core mining business.
We saw that play out perfectly in Q1 2025. Revenue was up 30% year over year. Sounds
So
good,
it's great. But
but they posted a net loss of, wait for it, $533.4 million.
oof, how?
Mostly an unrealized loss on their Bitcoin. $394.2 million of it. Bitcoin's price dipped in that quarter, and boom, it hits the bottom line, even though they didn't sell.
So strong revenue growth completely wiped out by a paper loss on Bitcoin. Wow.
Which underscores why their strategic shift towards owning energy and mining infrastructure, that vertical integration is so critical for them.
Right, to try and get control over those costs, make them more predictable,
Yeah.
especially after the having cut the rewards.
Exactly, but it's a massive change from their old asset-light model. Now it's all about capital-intensive projects.
Which means new execution risks, right? And needing a lot of money up front.
Definitely. So today we're going to unpack all of this. We'll look at the business itself, evaluate the management,
Dig into the financials, gauge the market sentiment, see who owns the stock.
and wrap up with a risk assessment, a SWOT analysis. Then we'll try to pull it all together from that value investing angle.
All right, let's do it. Chapter 1, Understanding the Business. So MARA calls itself a global leader in digital asset compute. They also talk about focusing on sustainable and inclusive futures.
Marketing speak? Maybe. But the core business is clear. Crypto mining, mostly Bitcoin. But they've recently dipped their toes into CASPA.
And their value proposition, as they frame it.
It's twofold, really. Securing the Bitcoin blockchain, obviously. But also this idea of contributing to energy transformation, converting clean or stranded energy into, economic value.
Okay, and they operate at a pretty big scale. April 2025 numbers showed 57.3 exahash per second of energized hash rate.
And a huge Bitcoin stash, 48,237 BTC. They mentioned 16 data centers, 4 continents, though the specifics outside North America are a bit fuzzy in the sources.
It's interesting how their name changed too. Marathon Patent Group. Kind of a patent troll rep back then.
That's how some described it.
Yeah.
Then Marathon Digital Holdings, pure Bitcoin focus. And now, since August 2024, just MERA Holdings Inc.
Any idea why the latest change?
Looking at their Q1 25 communications, it really seems to reflect that broader strategy, becoming this vertically integrated digital energy and infrastructure company. Less just about Bitcoin mining itself.
Gotcha. But the industry they're in. Wow. Intense competition.
Oh yeah. Huge capital needs for the latest hardware. massive energy bills.
And miner profits are always dancing on the head of a pin, right? Bitcoin price, mining difficulty, the halvings, energy costs.
Exactly. That April 2024 halving was a big one. Cut the block reward from 6.25 Bitcoin down to 3.125.
Squeezing margins hard, puts enormous pressure on efficiency.
We saw that in MRA's Q125. Their hash rate was up, but actual Bitcoin production dropped 19%, halving plus rising difficulty.
What about the regulatory side? Feels like it's always shifting.
It is, but there was that U.S. executive order in January 2025, strengthening American leadership in digital financial technology.
Sounded kind of positive.
Yeah, seemed to signal support for responsible growth, maybe more regulatory clarity. It actually revoked some older orders.
Grr.
Globally, there's also a big push for AML-CFT compliance for digital assets.
So clearer rules could actually help establish U.S. players like MRA.
Potentially, yeah. Reduces legal risk, might help with institutional adoption, which is already growing thanks to things like the Bitcoin ETFs.
And miners are looking beyond Bitcoin too, right?
Yeah.
HPC, AI, using sustainable or stranded energy.
Definitely exploring those avenues
says-
and constantly chasing more efficient ASICs. That's the specialized mining hardware.
Which brings us to the moat question.
Yeah.
Can you even build a sustainable competitive advantage in Bitcoin mining? It feels like a commodity business.
It's really tough.
Hmm.
But Mary is trying. Their scale is one angle. They're one of the biggest public miners by hash rate and Bitcoin holdings.
Does that give them real advantages, like better deals on power or hardware?
It could. In theory, yes. Purchasing power, maybe better terms on energy contracts, but the details aren't always public.
Their energy strategy, though, that seems like the core of their moat-building effort, this vertical integration push.
Absolutely central. They're moving away from being asset light. End of 2024, they owned about 70% of their capacity. After buying that Garden City site, they now own 54% of their 1.1 gigawatt portfolio themselves.
They've made some big buys there.
Yep. December 23, those generate capital sites in Texas and Nebraska, 390 megawatts for $178.6 million. They projected a 30% cost per coin reduction there.
And the Applied Digital site.
March 24, Garden City, Texas, 200 megawatts near a wind farm, $87.3 million cash, aiming for renewables and another 20% cost reduction at that specific site. Plus, they bought interconnection rights to another Texas wind farm in Fed 25.
And they're really pushing the stranded energy angle, aren't they, using flared gas?
Yeah, gas-to-power projects, behind-the-meter stuff. Management claims their lowest costs are at these sites. They're projecting like $10 per megawatt hour, all in for the new wind and flare gas. Very ambitious.
If they can hit that, it would be huge. Mitigate energy price swings, lock in low rates post-halving. What were their costs recently?
Q125, at their own sites, purchased energy cost was $35,728 per Bitcoin. Average direct energy cost of 4 cents per kilowatt hour. So yeah, hitting that $10 rental water target is key to bringing the overall cost down significantly.
If they're also investing in tech, right? Not just energy.
Correct. Their investment in Auradime, that U.S.-based ASIC maker, is a big deal. They're a founding investor.
The goal is custom, efficient miners, made in the USA.
That's the idea. Reduce reliance on imports, maybe get an efficiency edge. They said manufacturing started in Q125, and they put more money in recently.
But you mentioned a potential wrinkle.
Yeah, just that Auradime's public website seems more focused on data solutions and something called Explora.ai than ASICs. Maybe just a messaging difference, but it's something to note.
Okay, what else on the tech front?
Their own immersion cooling tech 2PIC, they're piloting it, aims for higher hash rates, better efficiency, maybe lower data center build costs, and they have their own mining pool software, MAR pool, claim it outperforms standard pools.
And the diversification plays, AI, HPC, COSPA.
AI and HPC are exploratory. Management mentioned advanced discussions for 2025 pilots, but it's nascent, COSPA. They started mining it in June 24, initially reported great margins. But the Q125 filing showed way fewer COSPA coins held than expected, and no update for March. So did they sell? Is it no longer material? The initial hype needs validation. It's unclear.
So how do they stack up against competitors like Riot or CleanSpark CLC?
Good question. MRA leads in energized hash rate right now, but their Q125 energy cost per coin at owned sites, $35.07K, was actually higher than Riot's average for all of FY24, $32.00K. CLSK looks very competitive on fleet efficiency, JTH.
So MRA really needs those low-cost energy projects to come through to be cost competitive.
Absolutely critical. Bitcoin mining is fundamentally about low-cost production. Hardware efficiency and cheap power are king.
Okay, so summarizing MRA's strategy. Multifaceted moat-building attempt energy, ASICs, software, diversification. Bold.
Very bold. And high execution risk. Vertical integration sounds great. Diversification makes sense. But slip-ups could really hurt. I remain cautious on CASPA and AI for now.
But that potential shift in U.S. regulation, the responsible growth idea, that could actually favor a big established U.S. player like MRA, right?
It could. Clearer rules reduce uncertainty, might attract more institutional money. MRA is probably better positioned for compliance than smaller players, though responsible might also mean higher costs, environmental standards, reporting, etc.
And their whole energy transformation narrative using stranded gas and renewables, that plays into the ESG trend.
Seems like a strategic ESG pitch, yeah. Aligns with the green mining push, could appeal to certain investors, maybe help with regulators, but we need transparent data on the actual environmental impact, especially given their history with things like the hardened coal plant.
Right. Okay, let's shift gears. Chapter 2, management evaluation. Let's talk about CEO Fred Thiel.
Okay. Thiel's got a long tech background, over 35 years, digital assets, AI, semiconductors, software. He's been around. Previous CEO gigs at Local Core, Lantronix, Stockholm School of Economics, Harvard Business School.
Joined Maera's board in 2018, became CEO in April 2021, and the market cap grew significantly under his watches.
Reportedly, yes. From under $30 million to over $5 billion at its peak. He's definitely the architect of this pivot to the vertically integrated model. Own the energy, own the infrastructure.
His vision, vertically integrated digital asset, digital energy, and infrastructure company. That's the Q125 quote.
Right. Strategic focus.
Yes.
Low-cost power, efficiency, diversification, AI, CASPA, proprietary tech.
But it hasn't all been smooth sailing. Controversies, challenges.
Well, there's the Hardin, Montana situation, that 2020 joint venture. Led to SEC subpoenas in September 21 and again in April 23, potential securities violations related to stock issuance.
Still ongoing.
As far as we know. The company says they're cooperating. We expected an update in the 2024 10K, but the snippets we reviewed didn't have the latest details. It's a definite legal regulatory overhang.
And the noise complaints in Texas?
Yeah, Granbury, Texas. They took over operations there in April 24. By October 24, residents filed a lawsuit. Excessive noise, nuisance, health concerns. They want an injunction for noise reduction.
MERA's response.
They deny the allegations, say they're within legal limits, want to be a good neighbor. They've built a sound wall, plan to use immersion cooling. But it's another legal battle, potential operational disruption. Updates usually in the commitments and contingencies part of filings.
And Thiel's background before MERA, you mentioned the patent group days?
Right. He was involved when it was Marathon Patent Group, which, as we said, had that patent trolling label from some. He also led a crypto exchange project called Sprocket that ran into regulatory hurdles.
Okay. Let's talk capital allocation. How are they using money? What's the strategy?
Aggressive expansion. Heavy investment in that vertical integration. Holding on to their Bitcoin, the HODL strategy. And financing a lot of it through equity offerings.
We talked about the big M&A deals already, Generate Capital sites, Garden City, the wind farm interconnection, Oradigm investment.
Right. Significant capital deployed there, aiming for those cost reductions and tech advantages.
And the HODL strategy, just stack sats.
Pretty much.
Yeah.
Retain almost all mined Bitcoin. 48,237 BTC as of late April 25. They do use some for lending or collateral. Look like over 14,000 BTC were loaned or collateralized end of Q125. But the main goal is maximum exposure to Bitcoin's price.
Okay, but how are they paying for everything? You mentioned equity.
Yeah. Heavy reliance on at-the-market ATM equity programs. They finished a $1.5 billion one, then immediately set up a new $2 billion ATM program in late March 25.
$2 billion. Wow, what are they using that for?
General corporate purposes. Buying more Bitcoin, mining gear, expanding facilities, potential M&A, basically funding the growth strategy.
How much dilution has this caused?
A lot. In Q125 alone, they sold 5.4 million shares under the old program for about $100 million net. Shortly after starting the new 2BIR program, they'd already issued another 5.2 million shares. Outstanding shares jumped from around 243 million end of 2023 to about 346 million by March 2025. It's significant dilution.
No dividends or buybacks, I assume?
Correct. All focus on growth. They do use debt convertible notes, lines of credit backed by Bitcoin. They did report cutting debt by 56% in 2023, though.
So management's basically prioritizing scale and Bitcoin accumulation funded by selling stock over near-term profits or preventing dilution.
That's the gist. It aligns with a super bullish long-term Bitcoin view, but it clashes with traditional value investing principles, focus on cash flow, return of capital, avoiding dilution. Investors here are betting the growth payoff will be huge.
And how they handle those controversies. Granbury noise, the Hardin SEC probe, that's a big test for management, right? Transparency, ethics.
Absolutely. Value investors want trustworthy management that tackles problems head-on. Granbury could disrupt operations. Harden could mean fines, restrictions, loss of confidence. Critical test.
Plus, this whole pivot, energy producer, infrastructure manager, maybe ASIC maker,
Right.
it requires totally new skills from management.
Exactly. Amplifies execution risk significantly. They're playing in new, complex arenas now.
All right, Chapter 3, financial health. Let's get into the numbers. Q1 2025 and recent trends. Bitcoin production, revenue.
Okay, Q1 25, they mined 2,286 BTC. That was down 19% year over year, mostly due to the halving, but revenue was up 30% to $213.9 million, thanks to higher average Bitcoin prices during the quarter.
And April, after the halving fully kicked in.
Production dropped again, 705 BTC, down 15% from March. Network difficulty went up. Their energized hash rate was 57.3 EHs.
What about full year 2024 versus 2023?
FY24, mined 9,457 BTC, bought another 22,065 BTC, held almost 45K BTC end of year. Revenue $656 million, FY23, mined 12,852 BTC, revenue $387.5 million. So production was actually higher in 23, but revenue much higher in 24 due to price.
Okay, cost of production, that Q1 number again?
At owned sites, purchased energy cost was $35,728 per BTC. Average direct energy cost $68.2 million on third-party hosting and energy.
How does that compare? You mentioned ROD and CLSK earlier.
Right. Riot's FY24 average was lower, 32,216 BTC. CLSK's all-in cash cost for their Q4 ending SEP24 was higher, 52,482 BTC. So Kinea's reported energy costs were kind of in the middle, with the hope those new projects bring it down.
Hash rate growth looks strong. Efficiency.
Hash rate definitely growing, 54.3 EHs energized in Q1, up 95% YoY, reached 57.3 EHs in April. They claim a 25% YoY improvement in daily cost per petahash, but they don't report a specific JTH figure like competitors do, so direct hardware efficiency comparison is difficult.
Okay, the big one, profitability, that Q1 loss.
Yeah, net loss $533.4 million, or 1.55 sats per share. But again, the main driver was that $394.2 million non-cash loss on Bitcoin valuation. Adjusted EBITDA was also negative $483.6 million. Operational gross profit looked like roughly negative $55.7 million.
That's a stark contrast to FY24 and FY23 net income numbers, 541 meters and 261 meters, respectively.
Totally. Shows the extreme volatility. Gross profit margins swung from -169% in 2020 to plus 73% in 2021, then negative again in 22 and 24. EBIT and net income margins also bounce around wildly.
So the financials really look like a Bitcoin holding company that also mines, not a predictable operating business.
Exactly. That fair value accounting for Bitcoin dominates the bottom line, masks the core mining profitability. Q1 loss was mostly Bitcoin price movement. CFO even suggested it could reverse in Q2 if Bitcoin recovers. PE ratio was useless here.
You really have to strip out those non-cash items to try and see the underlying operational health. And the HODL strategy just magnifies this whole effect.
Precisely. Now, financial stability and health. Debt.
Yeah, what's the debt picture look like?
As of March 31st, 2025. It's substantial. Over $2.2 billion in convertible senior notes. Those carry dilution risk. A $350 million line of credit collateralized by Bitcoin that has price risk, plus some leases. Total debt around $2.6 billion.
Debt to equity.
High, 69.7%. Net debt to equity, 64.4%. Both metrics have climbed a lot over 5 years. Total liabilities to equity around 72.9%. Significant leverage.
Liquidity. How much cash do they have on hand?
As of March 31, 25. $196.2 million in cash and equivalents. That was down quite a bit from year-end 24. And $12 million restricted cash. Worryingly, they had negative working capital of negative $76.6 million.
Meaning short-term assets don't cover short-term liabilities.
Correct. Their biggest liquid asset by far is their Bitcoin stash, worth $3.9 billion then. But that value swings wildly.
Cash, though, are the burning cash?
Q1 25, yes. Net cash used in operations was negative $215.5 million. Net cash used in investing was negative $209.8 million, buying Bitcoin wind farm. Net cash from financing was $229.8 million. ATM equity drawing on credit line.
So they're funding operations and investments by selling stock and borrowing more?
Largely, yes. Investing Pro noted they're quickly burning through cash. Free cash flow yield was negative 37%. Approximate Q1 25 SCF looks like negative $281.5 million. Historical SCF is variable, maybe positive in 23, projected 24, but Q1 was a big burn.
Negative working capital, cash burn, big capex. Really highlights that dependence on external financing, right? ATM and Bitcoin-backed debt. Risky if markets tighten or Bitcoin tanks.
Definitely. It's the opposite of what value investors usually like, self-funding businesses.
Ooh, what about return on invested capital, ROIC? Can we even calculate that meaningfully?
Very difficult. Earnings volatility, changing capital base. Q1 25 operating income was hugely negative, so no PAT and ROIC are negative. Fintel showed TTM ROIC and a 4.05. Hard to separate operational returns from Bitcoin's price impact. The vertical integration is supposed to improve operational ROIC eventually.
Looking back historically, say 5 years, it's just volatile revenues and net income tracking Bitcoin cycles and their expansion.
Pretty much sums it up. Big losses, then big income, often Bitcoin-driven. Massive growth in production hash rate from 2021. Long-term success really depends on getting that all-in production cost consistently low, below market price. That Q1 energy cost, $35.07 BTC, needs to trend down as the new energy comes online. That $10 millimeter target is key. If not, they remain a leveraged bet on Bitcoin's price.
Okay, second half. Chapter 4. Market sentiment. Sounds like it's all over the place.
Completely. Polarized, just like opinions on Bitcoin itself. Analyst coverage shows this clearly. Ratings and price targets are widely dispersed.
What's the consensus range?
As of early mid-May 25, seemed to be roughly $21 to $27 on average. Zacks said $21.46. 12 analysts ranged $9.52 to $1 on ours. Finance magnates reported $26 to $27, 13 analysts, high $43 Cantor, low $23 to $2 HCA Wainwright. Fintel's average was $20.23, range $9.60 to $31.50.
So ratings mostly buy or hold.
Generally, yeah, leaning that way. Zacks ABR was 2.29, buy hold.
Any color from specific analysts. Cantor sounds super bullish at $43.
Yeah, they seem high on the vertical integration AI potential. JP Morgan more neutral, $29, balancing growth and crypto volatility. But then you had Compass Point downgrade to strong sell in early May. So really conflicting views.
What about earnings estimates? Are they expecting profits soon?
Nope. Near-term losses projected. Consensus for Q2 25 was a loss of 38.38 cent share. Full year 25 consensus loss was $1.98 share, and estimates were revised downwards in the much before mid-May.
Okay, what are the market indicators telling us? Short interest.
Consistently high. Very significant bearish sentiment from shorts. Fintel showed almost 92 million shares short, over 26% of the float. Days to cover around 2. High off exchange, short volume 2. It's been elevated for a while.
Options market active.
Extremely active. Lots of calls and puts traded. NASDAQ data showed high volume around various strikes. Fintel's put-call open interest ratio was 0.58. Usually means more calls, which can be bullish, but could also just be hedging bets.
And volume and volatility.
Volume is massive, tens of millions of shares daily. Volatility is extreme. Investing pro beta 6.84. Fintel implied volatility 75%.
So putting it all together, high shorts, speculative options, crazy beta. Sounds like the stock price is driven more by sentiment, Bitcoin, and technicals than fundamentals.
That's what it strongly suggests. The market is sharply divided. Those analyst targets likely bake in very rosy Bitcoin price scenarios and flawless execution by MARA. Lower targets reflect skepticism or weigh the risks more heavily. Those negative EPS revisions show analysts are wrestling with the current headwinds having impacts. Costs.
For a value investor, you'd really need to question the assumptions behind those high targets and demand a serious discount, right?
Absolutely. Critically assess the inputs, especially Bitcoin price and execution risk. Don't just take the analyst target at face value.
Okay, Chapter 5. Ownership structure. Who owns MARI? Lots of institutions.
Yeah, significant institutional ownership. Fintel data showed around 60–62% of shares held by institutions like BlackRock, Vanguard, State Street, Geode. MAR's in the S&P 600 index, so index funds hold it too.
Who are the biggest holders?
According to their April 25 proxy filing, BlackRock had 12.9%, Vanguard 10.3%. So big index passive players heavily involved. Provides demand, but also means they're subject to broader market flows.
What about insiders? Management owning much?
Relatively low. Estimates range from maybe 0.7% to 1.6%. Key figures like CEO Thiel and CFO Khan hold millions of shares. But as a percentage of the total, it's small.
Have insiders been buying or selling?
Mostly selling recently. A lot of it flagged as automatic sell under preset 10b5-1 plans. Thiel, Khan, Mellinger all had automatic sales filed in early May 25. There were some dispositions for taxes, some RSU vesting acquisitions.
But the overall trend, net buying or selling on the open market.
Over the 12 months to May 25, looking at open market trades, insiders sold a net 300,000 more shares than they bought.
Consistent selling, even if automatic, doesn't look great when the company is also issuing tons of new shares, does it?
It can raise eyebrows, yeah. Lack of significant open market buys doesn't scream Insiders think it's cheap. Value investors like seeing management aligned with shareholders through significant ownership and reluctance to dilute.
And the float is high?
Very high, around 98%, contributes to that high trading volume and liquidity.
Right. Chapter 6, risk assessment. Let's do a quick SWOT. Strength.
Okay. Strengths, large scale, big Bitcoin treasury, that proactive energy strategy, vertical integration, renewables, proprietary tech attempts, Oradigm cooling pool, experienced CEO, diversification potential, CASPA, AI,
Weaknesses.
high earning stock volatility, historically weak operational profitability, or OEC, burning cash, negative working capital, heavy reliance on dilutive equity, lots of debt, including convertibles, operational risks like Granbury, past SEC issues, historical internal control weaknesses, Bitcoin adoption price goes up, successful execution of low-cost energy strategy could be game-changing. Oradigm delivers efficient U.S.-made ASICs, AI HPC diversification actually works, favorable U.S. regulations, maybe monetize some of their tech.
And threats.
Bitcoin price tanks, network difficulty keeps soaring, energy costs spike unexpectedly, U.S. tariffs bite harder on hardware infrastructure, unfavorable regulations, global or local, competition gets even tougher, execution failures on their complex projects, cybersecurity breach, hardware becomes obsolete even faster.
Let's unpack those tariffs a bit. The 2025 U.S. tariffs. How do they impact MRE?
Well, baseline tariffs affect imports. And since most ASICs come from Asia, especially China,
Tariffs raise the cost of miners.
exactly, increases capex for expansion, upgrades, slows growth potentially. It also hits components for their energy projects, solar panels, batteries, steel, transformers. Makes their low-cost energy ambitions more expensive and potentially slower. Thiel mentioned the impact on steel for their containers.
Are they doing anything to mitigate this?
Trying to. Oradigm making ASICs domestically is the big long-term play. Like Bitdeer's Made in USA push. They're also likely working on supply chain diversification, negotiating terms, expanding internationally. Abu Dhabi, exploring Europe Planum, could access different tariff situations. And maybe stockpiling or prepaying for hardware. Those advances to vendors on the balance sheet might partly reflect that.
So tariffs could actually push mining out of the U.S. and boost domestic manufacturing.
Could happen. Shifts global hash power. Definitely incentivizes domestic production like Oradigm.
And this tariff risk combined with their reliance on selling stock, that's a double whammy.
It's a compounded risk, yeah. Higher costs might mean more dilution, especially if the stock price is weak. Makes Oradigm's success even more critical, faster.
What other big risks stand out? Bitcoin price, obviously.
Always number one. Regulatory uncertainty, two. Crypto rules, environmental rules clamping down on energy use, carbon taxes.
And the ongoing SEC inquiry into Hardin, still unresolved.
Still unresolved based on available info. Potential penalties, restrictions, unknown outcome. Plus, operational risks like energy supply disruptions, even with vertical integration.
And the Granbury noise lawsuit. Could that set a precedent in Texas?
Possibly. Texas has already questioned mining's grid impact. Site-specific issues are a real risk. Plus hardware failures, intense competition, reliance on third parties for some things, and cybersecurity.
You mentioned internal controls earlier. They had issues.
Yeah, auditor gave an adverse opinion on internal controls for 2023. Material weakness related to intersegment sales accounting. SEC was involved.
Had they fixed it?
Management claims disclosure controls were effective as of March 25, and remediation is ongoing. But for investors, especially value investors, strong internal controls are vital for trusting the numbers. Given MRE's complexity, any recurrence would be a major red flag.
Okay, Chapter 7, Conclusion. Let's try to evaluate MRA using those Buffett principles. Understandable business.
Conceptually, Bitcoin mining is simple, but the tech, network dynamics, price volatility, plus MRE's diversification, it gets complicated fast, not a simple, predictable business model.
Favorable long-term prospects. An economic moat.
They're trying to build one, scale energy tech. But is it durable in this fast-changing, Bitcoin-dominated industry? Traditional moats don't really apply easily. It's uncertain.
Management. Able and trustworthy.
Thiel drove growth and the strategic shift. But the dilution via ATMs, the legal regulatory issues, Hardin, Granbury, past control weaknesses, these raise questions. Trust needs to be earned through consistent, transparent execution and good capital stewardship.
And price. Margin of safety. Can we even determine intrinsic value reliably?
Extremely difficult. Dependence on Bitcoin price, lack of consistent operational profit, shifting landscape. The current price is $16.21. Analyst targets, $21, $27 average, suggest upside, but rely on optimistic assumptions. A value investor wants a big discount to a conservative value estimate. Hard to quantify that confidently for Maraday.
Trying sum of parts or liquidation value probably doesn't work well.
Not really meaningfully, too many speculative inputs, operational risks. Just valuing their Bitcoin minus debt gives a number, maybe below market cap, but ignores the ongoing business, risks, and potential future value. Emeray's long-term viability really hinges on Bitcoin's path, hitting those low production costs, managing capital prudently, less dilution, navigating regulations, and making AI work.
So the final assessment from a strict value perspective.
The challenging. MRA looks more like a leverage play on Bitcoin's price and a bet on management's execution than a classic value stock.
That HODL strategy, great in a bull run, but risky otherwise. Doesn't fund operations.
Right. Unlike some competitors who sell Bitcoin to fund things, MRA relies on external capital, exposes them during downturns, forced sales, more dilution. Value folks might prefer more flexibility there.
And the success seems very tied to current leadership. Key person risk.
Definitely seems like it. Plus, venturing into all these different competitive areas increases execution risk. Value investors often prefer deeper management teams and more focused strategies.
So what does this all mean for you, the learner, trying to quickly but thoroughly understand MRA?
Look, it appears to be a high-risk, high-reward play, deeply, deeply tied to the volatile world of Bitcoin.
Their efforts on low-cost energy and tech are interesting, sure.
Intriguing, absolutely. But a true value investor would likely demand a much clearer path to consistent profits independent of Bitcoin's price, and a really significant margin of safety before jumping in.
So keep a close eye on their execution, right, on these big strategies.
Yeah.
And the regulatory environment, and obviously the price of Bitcoin.
Exactly. Which leads to the hook reveal. What about the market's take? Are the analysts and that heavy short interest seeing something that points to a different conclusion? Is there a signal in that noise?
That's a wrap on this deep dive into MARA Holdings. We've unpacked their business, management, financials, market sentiment, ownership, and risks, all through that value investing lens. Hopefully this gave you a shortcut to being well-informed without getting totally swamped.
And here's something to chew on. Considering MRA's huge Bitcoin stash and how sensitive they are to price swings, is the company really just a sort of Bitcoin ETF with extra steps and risks? Or are these strategic moves, energy, tech, AI, actually building a truly defensible, valuable business that can stand on its own, beyond the crypto hype cycles?
What do you think? Let us know. Subscribe to Stock Analytics AI's YouTube channel for more in-depth stock analysis. And remember, members at the Euro 4.99 level can suggest tickers for our prioritized deep dives right there in the comments.
Yeah, we're always looking for the next company to unpack.
And the usual disclaimer. Please remember, this analysis is for informational purposes only. It should definitely not be taken as financial advice.
Always do your own thorough research before making any investment decisions.